I'm gonna fire off a little TikTok here. Good morning to those joining us from the States. It's early. It's Wednesday. It's September 17th. I'm double checking the time because it's a little confusing, the jump. The math gets a little tricky once you start to get to like more than +6. That's where we're at in Bavaria. This is Munich, Germany, day 2 of the RMC Risk Management Conference through Cboe with a lot of great people. Great show today. Really smart folks. If I were to describe the way the kind of institutional-minded portfolio manager or trader here thinks it's like an F1 driver, which I guess is appropriate this side of the pond. These guys hit the gas and they're ready to hit brakes too. Cycling between the two means they're not interested in stuff like buffer funds and spending too much to protect on the downside. So that's a really fun theme here. Here's what's coming up today. Brent, Kochuba at the top of the show as we get ready for Fed cuts, basically. Market grinding and sitting at all-time highs. Yesterday, another good day. Bitcoin overnight, a little bit softer after what was looking like somewhat of a pop. It's cooled off a tad. Then we're going to get into some of the folks here at RMC Live. Jay Pestrichelli from Tidal Funds, which has basically been on top of the ETF world, finding massive amounts of income heaps. So he had a great panel yesterday. We're going to talk to him about some of the themes in the Tidal Funds suite of products. Kevin McPartland joins us from Coalition Greenwich, one of the best market structure minds. So we continue to explore that part of the equation for markets. Very important and a major theme on Chicago Future of Finance. Michael DeJarnette of StoneX Group joins us to talk about the prime brokerage business. And then Scott Bauer is going to get us ready for the trading day, Prosper Trading Academy at the end of the show. Let's go into the market. Let's talk SpotGamma, Mr. Brent Kochuba, and make sure that you are finding that QR code on the screen and signing up, because this is a really great way to view the market that I've been familiarizing with over the last several weeks here. Brent, first thing I like to do just to go to the general chart for the session. Little bit of weakness earlier this morning for futures, but what are you seeing?
Yeah, there's a little little weird blip down there that you mentioned, but at the moment things seem pretty stable. We're looking at the 0DT straddle today. It's at $45, which is about 68 basis points of movement. So the market's not even pricing in, quite frankly, anywhere near a 1% move, not only for today, but also if you look at 1 month implied vols, they're at about 13%. So even though there's so much focus on the FOMC right now, traders are not pricing in a lot of volatility. And so unless Powell kind of really surprises people here, the idea is that there's not a whole lot of reaction being priced in this market. The other big thing now that we have to watch is we've been talking about that big JP Morgan strike at 6,500. When you look at the charts, what you're seeing is positive gamma is now filling in between 6,500 and 6,600, which is a stabilizer. And so right now it's going to, I think, take honestly a pretty nasty comment or two out of Powell to incite a big drop, because of this fact that we don't see the gamma dynamics really driving a whole lot of downside volatility. And there's a mild amount of volatility being priced in right now. But, people are clearly not bracing for any kind of an Armageddon today.
Okay. So to your point, we talked yesterday a little bit about some of the forces of the 0DTEs, which have largely been positive, kind of giving us that stepping stone higher. And it looks like that's still intact, basically. But if those volumes subside, is that something we should watch as a possible, kind of sentiment shift? Or tell me that logic that you're using this week.
Yeah, what happens when a real risk event comes up, like an FOMC, a kind of a known unknown, that is, I know that the FOMC is coming up here. He may come with a hawkish or dovish tilt. Let's say he comes with a hawkish tilt. I don't know how long the market may draw down for. I can't be in the 0DT space, right, when there's this known unknown that's going to come up. So what happens is that 0DT volume tends to fade a little bit on a risk event. And then what happens if the risk event passes without issue, if it's a benign risk event, then that 0DT comes flooding back in. This is why in April, when we had the tariff changes and the credit markets were starting to falter, 0DT flow just kind of disappeared, right? So the 0DT flow is really a function of the amount of risk that traders are pricing in. Okay. So, for today, we have VIX expiration rate at 9:30. We don't want to skip past that one because there's a fair number of contracts expiring right around the 15 level. So that's going to upset or sort of reset some of the positions in the volatility complex. The contango in the VIX term structure has been very steep lately, kind of unusually steep. Some of the banks have said that is because of some of these leveraged ETFs like the UVXY and the VXXs of the world getting extra flow coming in.
So there's some term structure on your platform here, Brent.
Yeah, and you can see how elevated the SPX term structure is there because we have the FOMC today. So that 28% implied vol looks high, but because it's a 0DT option, we actually look under the hood there.
Okay.
It's pricing in, again, about 68 bips of movement.
It's going to dissipate quickly, expectedly.
Right, and if you bump out just about a month, you hover over about a month, you'll see about 13% implied vol. To get a 1% implied move in the market, you need a 16% implied vol. So, yes, the VIX is around 16ish right now, 16.5. But S&P, as you can see there, the S&P fixed strike vol is at, you're seeing some 12s in there, right? So
yes,
there really isn't very much risk at all being priced into the market. Now, what you would say as kind of the steelman, the bearish side of the equation is if Powell does upset expectations, there's a pretty good amount of travel for vol to move higher, right? Historically, you see an average VIX can be 14, 15 without issue. So, this is a pretty normal level of VIX, kind of 16. But that fixed strike vol, which is showing us a little bit of a different signal than the VIX complex, that 13% implied vol for the S&P is quite low and obviously can shift quite a bit higher if Powell, does spook the market at all. I think ultimately what you should always bet on in the FOMC is Powell doesn't really do anything to upset markets. And in that case, you would see vol probably contract a little bit. And the way that the dynamics that changes the market has rallied here is that there is more implied support now. We got more room between us and that JP Morgan buffer at 65.05 at the end of the month, right? So, you could see I think a 2, maybe 3% decline, but I wouldn't expect a whole lot more than that because we have these kind of stabilizing forces down below.
Okay, that's good. Brent, I plugged in a question to the AI today for us related to the Fed to kind of see what the narrative is. I think you pretty much hit it the way the market sees it already, which is that the market is saying volatility is likely to subside. and that this is likely to be a volatility diffusing event. But the AI kind of came at it from the macro perspective, which I thought was kind of interesting. Which basically is, I said, look, what's the market response effectively of AI, of the Powell cutting? And essentially, it says, look, you want to make sure that we're cutting for the right reason. It's not the notion that rates are lower. It's how the signal is received and transmitted. It says that it works only if banks and borrowers actually use cheaper credit. Otherwise, it just inflates assets, which I think is kind of funny because obviously it might be a little too late for that part. Long-term cuts can trade today's stability for tomorrow's fragility. I mean, look, do you see any catch 22 in cutting rates here from the macro perspective, or is this just something that once the market's priced it in, you got to do it?
I mean, market is totally priced priced it in. 94% odds of a cut today. There's millions of 3 rate cuts this year. The retail sales number was pretty good yesterday, so there's some conflicting kind of evidence or conflicting narrative around, do we get more cuts than this? Today is definitely priced in, and rates seem to have been sliding lower. So that's all true. And for Powell to sort of upset the apple cart here and get the market sliding south would be not a change necessarily for today. So everyone knows we're getting 25 basis points today. That's almost guaranteed. So what is the forward guidance, right? And forward guidance is everything. And if Powell deviates from that, then you should see vol move and you should see equities move more than anticipated. If you deviate from consensus, that's where the trouble comes. So I think there's a little bit of hand wringing now due to the retail sales number yesterday. There's some conflicting evidence that things are actually that weak in the economy. And so do we get the 3 rate cuts that it seems like we're headed for? Not too long ago, we were talking about maybe getting a 50 basis point rate cut today. There's a giant options traded in the STRS market that was sort of related to this as well. So, there's still the question now is like, do we get more than 25 bips into the end of the year? Do we get 50? Or, do we get another 3rd rate cut? Or are we done here, right? And I think if the market starts to come around to the idea that we're done here, then maybe that sort of leads to a little bit of an equity interim top, right? But the kind of fact here is that we've rallied about 2% over the last week and a half, and that has added a fair amount of stability to the market. And now I think with that retail sales number, with the speed of the rally, vol's now up a little bit, which gives you a little bit of padding, right? Because if we were heading into this with even lower implied vol, then I think the risk of the downside would be sharper. So I've had to kind of like tone down the bearish language a little bit here due to the way the market's starting to price in the risk. But kind of the fact is that there's some support in this market right now. I think the narrative is pretty clear. People know what to expect with 25 bips today. And, unless Powell kind of goes really hard on the hawkish side, then I think we kind of got to assume that's business as usual and start looking at some of those upside levels. I think we may have lost Oliver today, so lost everything. All right. Can't tell if the internet is with me or not right now.
Internet was a little spotty from the conference. Yep. Yeah, boy, this thing is really going in and out.
Which Wi-Fi are you on? RMC or on Weston?
Weston. I know. You see me still? Can we hear me?
Yeah.
Can Brent? I don't think Brent can hear me. There are two things about Chicago finance you can't get anywhere else. The first is kind of hard to miss. Everyone's trading options. Cboe is on a 5-year growth streak making billions, and its goddess of grain sits atop the final pit of open outcry. And that's what it's all about. The chance to fend for yourself. A fortress for the self-made trader, and the only still standing in America. The second thing you may not know, but it's worth trillions. Chicago is the only major city in America that's home to 2 of the top 10 registered investment advisors, according to Barron's. That means a steady river of passive money and fixed income pouring into the city. If you think you can beat the market, this is where you do it. If you've got value, price will discover you here in Chicago, the future of finance. Join me, Oliver Rennick, from Cboe, Tuesday, Wednesday, Thursday, into the closing bell, live from Chicago. Okay, welcome back. A little spotty with the conference Wi-Fi, but we are live again. And I've got Mr. Jay Pestrichelli joining me from Tidal Funds, Chief Trading Officer at now a $45 billion shop with a lot of growth in the past year. Jay, great to see you.
Yeah, Oliver, great to be here. Good to catch up, man.
Yeah, we've been talking for a long time about options and strategies and funds, and the Tidal story now is one that a lot of people know. A lot of people have heard about. I think a lot of people know you if they're in the options world, but now they see you as the representative of these highly successful, very popular products that are using options, income, heaps of it, yield max suite, and it's spurred a lot of, I think, kind of imitators too. So tell me firstly about how you've kind of received the growth of this market. How do you feel about it?
Yeah, look, this is, I like to say when it comes to these ultra high dividend products, right? High distribution products, we're kind of defining a new asset class, right? So it's not uncommon for other folks to kind of see that and take their, develop their own take on it. And that's okay. Like, we welcome competition. It's fine. It helps actually support the concept of the industry, right? So to speak, right? So it's great. It's great to see other issuers come out. We actually welcome a community of other funds that have high distributions, because again, it's one of those things. It's clear the investors want them. You talk about the growth, right? You go back to 2022, there was hardly anything in this kind of options based high distribution world, but there's been some like originals in this, right? You look at the JEPIs, QILDs of the world,
right?
And they were kind of breaking this first ground using covered calls and distributing something like 10 to 12%. And that was obviously very interesting and was proof of concept. We then took the twist of single stock, right? Okay, can I do a covered call on a Tesla or on an NVIDIA, right? Oh yeah, we can. And guess what? IVs are much higher, implied volatilities are much higher. Yeah, and so now you start to distribute things like 40, 50, 60% on an annualized basis, and it opens a lot of eyes. So again, little groundbreaking. We understand other people are here, but the growth has been supported by the investor. When we look in our space, it's, we're probably approaching 20 billion of assets just in these types of funds. And so clearly, if the world keeps buying them, we'll keep making them.
Right now, I'm literally tweeting this out that you're basically kind of the king of the hill of ETFs in my mind for right now, Tidal, because of the representation. And this is really interesting. You set me up perfectly for something I wanted to talk about, which is how the line is kind of blurring between what we talk about in retail and what we talk about in institutions. Here, it's a much more institutional vibe than we were at in Robinhood last week. However, you just gave a shout out to Kevin Kelly of the QILD, and that kind of way that there was this platform kind of built, this runway built to get to where we are with these funds. We talked with him at Robinhood last week. There's an irony that we're having very similar conversations at this highly institutional event as we did on the show last week at Robinhood. What do you make of that?
Yeah, look, always good for a shout out for Kevin, right? So he's a partner of ours in a few funds. But yes, it's interesting to watch that. He was a leader here. We kind of replicate, and then now he has a Bitcoin, right? Call strategy, right? So does Yield Max. So does actually almost everybody in the space at this point.
Exactly.
Right?
And so you've got people with massive institutions that are kind of swimming in the same waters. as everyday investors? Is that just kind of is the option, the linkage between that, the options instrument?
Yeah, I would say when you look at, say, the retail investor versus the institutional investor and the advisor, the adoption has yet to make its way outside of the retail space, right? Almost all of the assets in these funds are really coming from the retail side. When you look at like the largest holders of any of these ETFs, the largest holder may be $4 or $5 million. That's it. And on a $5 billion fund, you go, well, it has to be this humongous swath of retail investors that are just pouring in, and that's really the case. So I don't even think we've seen the institution adoption
break
yet.
That wall down? Is that why you're here?
Well, always, right? I always love coming to the Cboe Risk Conference because it's just one of those things that you get to meet all the professionals in the industry, get to hear what all the innovative ideas are that are going on there. And yes, of course. Now, look, this group here is a little more institutional, right? We're not buying. This is not really where a lot of the, I'll call them allocators, go. They may come here to learn. This is more what I like to say, the pipes, the nuts and bolts of what keep the ETF and the derivatives markets working so well. Yeah, of course, we want to get more exposure here. Here being in Munich, maybe there's an opportunity to apply to Europe, right? I think that's around the corner for all of us.
Do you think that these types of funds are an answer to advisors who want to try and deploy an option strategy for their clients? Even if they're big advisors, if they're in the $5 to $10 billion range and they're going, we don't really use options, but it seems like everybody is. Are these funds a representation or an alternative for them to just say, all right, let's park some money here and let you do my options magic for me?
Yeah, absolutely. I mean, there's no doubt that that's the way. When you look at the past, the big adoption has come in the what's in jeopardy these days, $40 billion in that product. That's a lot of institutional use that's happening there. We expect the same thing to start to occur in these newer funds, even these ultra high yield funds that we're talking about here. And look, Tidal likes to be on the forefront of this, whatever the product can be. The only other thing I would add here is sometimes it takes time. Right, time. The proof will be in the pudding over time. Max is approaching 3 years at this point, so seems like it's going to be here and still growing. Right, so I think you need time, you need to watch assets, and you need to learn a little bit about some of the dynamics so you know how to manage client expectations.
To that point, it's Risk Management Conference, and you got a question along these lines yesterday on the panel, which was a great panel. I brought it up to our AI. If we run the second, we've got my AI consultant here instead of my co-anchor. And basically, to pull that up, I asked it, okay, if the proliferation, because we're talking about the proliferation here of these types of funds where you guys have kind of led the way. But as you mentioned, there's a lot of now competition. So if the size and the amounts of invested money keeps going up in these options-based strategies, I asked, is there any structural risk being introduced through the popularity of income-generating option strategies and ETFs? And it basically says that it looks safe in calm markets, but when volatility spikes, if they all rebalance at once, it could amplify stress. When volatility breaks, the unwind will be synchronized. What do you think about that response?
That's a complicated response from your.
It's not bad.
It's not bad at all.
Is the AI thinking too hard, or is there a potential for volatility regime changes and the amount of income you can expect to reap from these things changes really quickly? Could there be an outflow situation that stresses any of it?
Yeah. So always outflows can be stressful for any asset class. However, because of the frequency and the active management, at least in our funds, I think it's activity that we're already doing every day, right? We turn the portfolio over weekly, right? We're selling weekly options, right? So all of the connections to the liquidity providers, very regular. We know who's on the other side of every one of our trades all the time. Can the industry handle just that flow of orders? Yes, because they're getting it all the time from us anyway. There's money flowing in and out of these funds every day. So there's daily trades that happen all the time.
It's not like,
This is not going to look. Of course, any event can stress any system, but this is not a monthly or quarterly trade. These are sometimes 2-3 times a week. You're rolling over the portfolio. You can get a Tesla, like the beginning of this week, moves 5-6%. Guess what? That's an event for a covered call strategy. You got to roll the whole thing up. BABA, been a big mover lately. But then you can get the flip side and you get the monsters like MicroStrategy, this slow decline. You're constantly rolling that portfolio down to capture more income. So I am less concerned about the pipes. Now, if you had asked me that question 2 years ago, I would have said, geez, I don't know what's going to happen in NVIDIA, right? We had a huge NVIDIA move in the beginning of July or June of 23, July 23. That was an initial test to see what happens with inflows and a large market move. so far, strategies and all of the activities between market makers, primes, custodians, all linked together, working fine.
Not to do your marketing for you, but the way I think about it is that because we're talking income, the risk seems like it would be a gradual, lessening of the income, and that it's not like it doesn't seem like a crash risk to me. What it seems like is like the more likely problem is that maybe the market starts to arb away some of this volatility, and you can't harvest as much.
Well, yeah, well,
different problem.
That is a different problem, but
a slow one.
I will tell you, we see our biggest inflows on the down days. Right.
Okay.
So if you're in the yield space, right, and you're doing your math and you have an idea what the dividend's going to be, if you could buy a stock or buy the underlying at a 10% discount, what have you just done? You've increased your yield, right? Yeah. So we see more inflows on down days than we do up days. Take a look at April.
Because vol up is good for you.
Well, vol up's good. We're selling for more premium, of course.
Yep.
And then the end investors buying the ETF at a discount than it was, say, 3 or 4 days ago.
Is this, and we got Mike coming up because one last question here.
Yeah.
Now, is that what about the scenario where vol goes down? Because it seems like a lot of the success of these funds is the environment where we've had price go up and we've had vol go up. So price goes up and your underlying is great, and then the vol's high, and you just keep harvesting that income.
Yeah, and it increases on the way up.
Right. Yeah. What about vol down, price down?
Yeah, MicroStrategy is a perfect example. Vol's been down as Bitcoin's vol's been going down, and the price has been down, right? Yeah. We're at 434, and now we're sitting in the high or low threes.
Right.
That drop has been accompanied by a drop in implied volatility. Still able to generate that 50-60% annualized rate.
It stays at that reduced vol, though. That's going to come in, and you have to say to your investors, you have to give an update and say, hey, look, we can't target 45 this time if it's things not moving that much anymore.
Yeah, look, Apple with a 20 IV is never going to be able to pay out 60-70%. Right. And that's okay. Just you know what you have.
Okay, love it. So the worst case scenario is your stock, it turns into Apple. Okay, no, we'll continue to monitor. It's a very fascinating space. I think it's really spot in the middle of what this show's been about, what we've talked about here versus Hood Summit last week, the use of options, the way it's kind of blurring that line between professionals and individuals. Great stuff, Jay. Thanks.
Oliver, always great to be here.
Appreciate it.
Thanks.
Jay Pestrichelli, Tidal Funds. We're going to come back and talk prime brokerage, and we're going to go kind of home to Chicago and talk about a deal very important to Chicago, and that's StoneX buying RJ O'Brien. Michael DeJarnette joins us next. Welcome back to Chicago Future of Finance, live from the Risk Management Conference by Cboe in Munich, Germany. Let's kind of go back to Chicago a little bit here, a deal that's very relevant to home, far away from home, it seems like in Europe. That is the StoneX acquisition of RJ O'Brien. Michael DeJarnette joins me, the co-head of the prime brokerage service at StoneX. Great to have you here, Mike. Great to meet you.
Yeah, thanks a lot. We really appreciate you having us.
This is kind of a nice little throwback to home right now. You guys executed a really big deal, especially for the futures market. The StoneX acquisition in July that closed with RJ O'Brien, which was like one of the earliest traders in Chicago. An incredible history there. You guys are now the biggest non-bank futures commission merchant. Give me kind of the top line headline of what that means.
The top line is just that over the years, there have been less firms clearing futures other than the big banks. And so this consolidation really helps us gain scale and really, I think, is going to help the market because it's a mid-tier player where there hasn't been one in a while.
What is, was the market not juicy enough to have multiple players there? Or where's kind of the margin, the edge being found in that market right now?
You know, it's just evolved like everything else has, and RJO, and like I say, I run the prime brokerage business, so this isn't as much my specialty, but
sure,
RJO has a wider breadth of products in the retail space, and StoneX on the future side has more of an IBD, introduced broker footprint, and putting these two together is going to I think really help us reach more clients.
Great, and a lot of good research too on the StoneX side. That was kind of my introduction to StoneX, and my coverage over the years has been through the kind of macro research side. So it's going to be very interesting to see kind of how everything fits together. Now, from your angle on the prime brokerage, what's interesting is when I think about the prime brokerage model, I feel like that's one with plenty of competition. But yet, especially in Chicago, I hear more and more about creative things happening in prime brokers. So tell me about what interests you and where you guys are pushing right now.
Sure. I've been in the prime brokerage business for a long time. Started a small independent prime broker in the early 2000s that was acquired by a Bank of New York affiliate. And the business was a lot different then. There were a lot more hedge funds that were popping up, people that would come out of large banks or hedge funds to start their own, hang their own shingle. And over the years, we've seen a little bit less of that, but the good news is we've seen a whole lot more active ETFs
that we were just talking about, right?
That need prime brokers because an ETF's a 1940 Act entity, and so they have to hold their long assets at a custody bank. But if they have derivatives, they have to hold the derivatives at some sort of a broker, and that's where being a prime broker has been very beneficial to us. We got into
because more and more than one are using options now.
Oh yes, absolutely, and more than just options as well. Anything that's considered a derivative, a short equity is considered a derivative by the 1940 Act.
Right. Okay.
So if
swaps,
if something's not held at the custody bank, it has to be held either at a swap dealer or a prime broker or something that's not classified as a custodian by the 1940 Act.
This is super helpful context too, because we're seeing how all the pieces fit together here. Kevin McPartland coming up next is a market structure expert, so we're kind of getting every angle of the beast here.
Right.
So how do you then, as we see active funds, a lot of options, as you're working to help them manage that load, how do you set up new guardrails for yourself, or what is the highway that you're traveling down? I imagine you've got to pave some new lanes or something in the system.
Well, coming from the hedge fund prime brokerage world, we're used to margin, we're used to portfolio margin, we're used to leverage. These products definitely, we have to have guardrails, but they're different because we're typically not dealing with the levered products. The swaps dealers are usually dealing with the levered products. We're usually dealing with fully paid for securities. The options positions are typically fully collateralized. It's more blocking and tackling than what we've done in the past because we have to be very cognizant of where the collateral is, making sure the collateral moves are happening on time, making sure that expirations are handled properly.
Right, are expired.
Yes, and assignments. We use a lot more. Our clients use a lot more flex options because for many reasons, but one of the reasons is because as a prime broker, we can't have assignments, and expirations cause very large equity trades when there aren't supposed to be equity trades.
Okay, very interesting. So to some degree, then to summarize sort of brutishly, but the hedge funds, it seemed, were a little bit more kind of Wild West, where everyone is doing something different. And at one period in time, I think 80s or maybe even early 2000s, lots of leverage, lots of risk being taken. Whereas a lot of these ETFs, even though we can kind of think of them as almost like mini hedge funds, like I saw the way Tidal funds, who they were hiring from other places, saying, okay, these guys are going there because they feel like they're running a hedge fund. Basically, they're trading. That's what they want to do. That's what they're good at. But to your point, a little bit more structured and kind of systematic and predictable, I guess, than maybe kind of the heydays of hedge funds.
Right. And I think that's probably why we've seen less smaller to medium-sized hedge funds over the last few years, is because the systematic trading needs to be at scale. And that lends itself to the ETF wrapper.
Does kind of a related point, as we asked Jay, okay, as more and more of these funds do this kind of approach and use options in particular, what are the risks that you see? Is it just eventually the trade gets arbed away, or is there something that you kind of have to keep an eye out for?
Well, there are collateral requirements at the OCC that they're relevant. So some of the strategies that get extremely large do have some constraints.
Sure.
Just because I think that maybe the collateral requirements and the way that they're looked at probably have to evolve over time.
Okay. Great stuff. Great context. Definitely want to keep exploring that subject. Mike, thanks a lot.
Thank you very much.
Yeah, really great insight into StoneX's prime brokerage, handling the massive ETF options load, a really key part of the market structure. Told you we were going to have good conversations today. We're seeing every angle on the elephant, if you will. So let's come back and get in the weeds with Kevin McPartland, one of the best market structure people I've known for a long time, who's here. It's kind of quiet here this morning on RMC Day 2. What's up? Where is everybody? It's lunchtime? Okay. All right. Fair enough. We'll be right back. Welcome back to Chicago Future of Finance, live from Munich, Germany. Kevin McPartland joins me to continue several of our themes and conversations we've had here. A market structure expert, a head of research of market structure and technology at Coalition Greenwich. You're at Greenwich Associates, which is your company for over a decade that we talked Last was probably a few years back. So it's great to see you again, Ken.
Yeah, great to see you too. Thanks for having me.
Tell me about what your main focus is at Coalition Greenwich right now from the market structure perspective, because I know you've got a wide range of things you can talk about. Tell me where we should be zooming in right now.
Yeah, so the market structure team at Coalition Greenwich, we really do run the gamut, everything from fixed income, equities, FX, derivatives, digital assets, of course, and all the infrastructure that powers all those markets. But yeah, I'm here mostly to talk about credit, fixed income markets, and sort of how that all plays in with derivatives and futures.
Okay. Yesterday, we talked about that very thing. iBox, David Litchfield from Cboe, and I thought it was a really interesting conversation because why not trade credit as a future?
Yeah, well, the story, it's actually a story that's been playing out since the global financial crisis, right? So we went through the crisis, there was new regulations on swaps, and the market thought, hey, everything's going to move to futures. Swaps are going to go away. Obviously, that didn't happen, right? So, but at the time, the idea was let's create a credit swap future, right? And that was the first try. I think the fatal flaw in the end was trying to get futures traders to trade swaps and swaps traders to trade futures. Neither of those folks want to do that thing, right? And so that product never really caught on at the time.
Interesting.
And
swaps people's more options people. Futures people kind of just technicians, price people,
Yeah, I mean, they're different worlds, and those products have different uses, especially at that time. And we'll have to go very quickly through a decade, but effectively that also drove the bond market to electronify, right? The dealers didn't have as much balance sheet to provide liquidity to the buy side, so the buy side needed to find another way to buy and sell their bonds. That ended up being through electronic platforms, right? And so electronic trading is now half of the investment grade bond market is traded electronically, about a third of high yield. I bring all that up because that is a big part of now why the newer breed of credit futures it does genuinely feel different this time.
Built on a proper structure, basically.
Yeah.
Now it's fertile ground to have this type of contract.
Well, so ETFs really started to impact the bond market in the sort of late 2010s. There was some SEC rule changes, which maybe we don't need to get into. But so that arbitrage, trading ETFs versus bonds, that really accelerated. That brought in more systematic traders. That increased electronic trading.
You can narrow that gap even closer now?
So exactly. So now we have an ecosystem of systematic credit traders who would think futures great, and hey, options on futures also great, right? And we can bring that all into this ecosystem with everything tracking a similar group of indices.
Interesting. There's almost an analog where the retail person has, now they're slinging options more than they ever have. The institutional, now on the credit side, has their own kind of derivatives building up, on the bond side. So I guess in that market, then how do you think where are the stresses if there's, this new style of trading in bonds? Is that applying any pressure? Is the bond market just so huge, so liquid? But then you get into specific names too, right? That aren't that way. This isn't treasuries we're talking.
No, well, that's right. I mean, to be fair, even in treasuries, the couple of year off the runs, right? Even those don't trade that much, but you're right. Absolutely. In corporate bonds, there is very much a long tail of bonds that barely ever trade. But what I think is interesting is even in those cases, there have been innovative solutions that have made it so, an asset manager could electronically sort of gather quotes and trade illiquid bonds. There's ways to reduce information leakage. There's ways to decide which dealer is best to bring in on that trade, or maybe in some cases put that that illiquid bond out to the whole market because that is the best way to get a price, which maybe will come from another asset manager.
The best way to find price is just to put it up for sale.
Yeah, there you go.
Okay, so it sounds like largely we can think about this as adding transparency to some extent, right? Kind of new ways. If you're a believer in capital markets generally and price discovery, then everything you're describing is kind of the equivalent of making like zero DTEs, basically.
Yeah.
Why not bring to the dailies effectively?
Yeah, I mean, if you're trading bonds against ETFs and then against futures, like that arbitrage amongst all of those products is what keeps prices tight and in line. And to your point, increasingly transparent, right? Futures markets do have that advantage of trading 24/7, and there's an order book, so you can always have that pre-trade price transparency. So it does add another element on top of, like I said, what's come from the ETF market, obviously, which is then all, I think, supporting the underlying bond market.
Okay, so when we've got a big move coming for the bond market, basically with cuts and the Fed, and how do you? I know that that's kind of a a short-term thing, but for those moments, it's a seminal moment. This one's really had a lot of drama leading up to it. How do you watch bonds to see kind of what their message is going to be over the next week?
Well, so I'll give you an interesting point. So when Powell was in Jackson Hole back in August, when you looked back at the volume data, you can see that credit ETF volume was up a little over 40% from the full month average, right? So there was a huge spike in trading volume in the ETFs, right? Because often if you want to quickly put on a macro position or get broad exposure, it's much faster to do it with an instrument like an ETF, and then, as we said, increasingly with a future, right? Rather than trying to trade the whole portfolio of bonds. Now, trading portfolios of bonds has also gotten a lot easier, but still not as quick as executing on an order book.
I'm kind of surprised. Then, I mean, look, I don't know the numbers necessarily, but it kind of seems like and it's a part of the market that I hadn't really spent too much time thinking about trading credit, and all the different facets. But I'm kind of surprised I don't hear more about the credit futures, to be honest. Am I imagining things?
No, I mean, I think
more institutions be using that.
They should. I mean, you can see the momentum is growing. The awareness is growing. We see that we did some research recently. We actually just published it just this week. But awareness was very high. So of the credit traders we interviewed, over 85% knew about the contracts, right? And that might not seem like a big deal, but in this case, I think it is. It's something people are just starting to learn about. And there is this catch-22 with any new contract where people want there to be liquidity before they trade them, but they need to trade them to make there be liquidity. But I think that snowball starting. There's competition in the market, which also helps.
That's like the economic fission required for a market to work, right?
That's right.
When you hit that critical mass.
So
people, they want to see other people in there.
It is. Everybody knows it's a slow grind, but there just seems to be enough natural interest in this market. There's macro interest in credit markets are interesting right now, and then, like we said, just the systematic trading strategies that really could put use of futures.
I think the analog I'm going with for this is the way 0DTEs filled in, every little dot on the volatility kind of surface. The futures now are kind of filling in as well, that kind of full perspective on
I mean, if you're comparing to equities and 0DTE, we're probably still 10 years behind. But yes, the pieces of the pie are slowly being filled in. Much more so than they were 5 years ago, let alone 10 or 15 years ago.
Sounds healthy.
I think it really is. And, retail demand for bonds is growing as well. I think you can see it in some of the Fed data that retail investors are holding individual bonds right now, compared to holding just funds more than they have in a very, very long time. A lot of that comes from electronification. Separately managed account usage is growing, again, because the managers of those accounts can automate them. They can automate the execution. They can automate the rebalancing, right? So then they can offer those products with lower minimums. That also, all of that helps the bond market. That just brings more money into the underlying bonds, which makes them more liquid, which brings in more investors.
Great stuff. Kevin McPartland, nice. Giving us some really good color on market structure. Admittedly, too, something that even when we talked in the past, I felt that, I had limitations on how much I could visualize. But now after seeing, how a lot of these dots connect and studying the market structure in Chicago and on this show, that it becomes very fun. Good stuff, Kevin.
Great. Yeah, thanks for having me.
Great perspective. Kevin McPartland, Coalition Greenwich. Yeah, top of the line, market structure analysis, bonds, getting more liquid and more ways to trade. We got Scott Bauer. Should we do a little risk radar? Okay, well, then maybe we just go straight to the risk radar here and a little chat about markets for a second because, we got, 1:20 p.m. right now, which means we got a little bit of time until we start trading. Why don't we come back in 1 minute? Let's go through the risk radar in 60 seconds. That work for you, Matt? Cool. Be right back. Okay, quick thought here ahead of the expected cut from Jerome Powell. My risk radar, since we actually started the show, hasn't even changed. That's because I think it's doing a pretty good job describing the macro setup. Stocks, green light, been that way since we started the show. Was it August 19th, I think was the first day of our show. So it's been almost a month now. And green on the risk radar for stocks has worked beautifully. Also thinking about yellow, green for gold has worked also, I think, beautifully. But yellow for bonds, yellow for dollar, yellow for Bitcoin has actually worked pretty well too. The dollar I might have missed a little bit because the dollar's gotten quite weak again. Dollar I might have to think about revising, but keep in mind the dollar is actually still above the 96 low from July. So maybe then the dollar, if it breaks through that, okay, red clearly for the dollar. But otherwise, bonds have been strong for sure, but maybe the bonds need to go green at this point. But if you look at the bond price, we had higher levels in April. So again, the 10-year yield, it's dropped a lot. It's at 4%, but we're still above the 3.8 low when we had that tariff panic and markets were getting killed. So we get below 3.8, then very different story, I think. However, you might be able to expect a little bit of pushback here, I think, from bonds. Keep in mind, when Powell started the original cuts in this past cycle, that's when yields actually bottomed out. So if you start helping the economy, if the cuts are really effective, there's a logic that's pretty clear to argue for actual steepening of the curve. So we'll see. So far, it hasn't been that way in terms of just the long bond rallying and pushing yields down. But let's see if maybe we find a little yield support at 4%. Then Bitcoin, yellow because it's still in below that 120 range. Got to get above the 125. Green light, get below the 110. Red light, pretty simple there. Gold, what is there even to say? It's just majesty. Question is just what else do you need in this market besides stocks and gold, it seems like. Thanks for joining at RMC. Hope you enjoyed the conversations. I'm going to have some fun in Germany for a couple of days. I will see you next week. How do I say goodbye in German? I'm finding my solution is I'm in Europe is to just do the impression of where I am in my own English accent. From Paris to Germany. All right. Thank you for joining. Appreciate it, Matthew and guys and team and Jared and Steve for setting up here. Thanks to Cboe at RMC Munich for having me. And thanks for everyone for coming out. Panel tomorrow morning. If you're here, don't miss it.